Our next concept is dual aspect concept. Dual aspect. This concept is more like business entity concept. It is similar to that. No. Sorry. Do every transaction has two aspects. That is okay. Two effects. At least two effects. So dual aspect concept. This concept is based on double entry bookkeeping. Which concept is based on double entry bookkeeping? Dual aspect concept. So this concept, that means dual aspect concept, is based on double entry bookkeeping, which means that accounting system is set up in such a way that a record is made of the two aspects of each transaction that affects the records. Two aspects. There are two aspects of each transaction. The recognition of the two aspects to every transaction is known as dual aspect concept. The recognition of the two aspects. We recognize that there are two aspects. So the recognition of both aspects or two aspects of every transaction is known as dual aspect concept. Modern financial accounting is based on dual aspect concept. One entry consists of debit to one or more accounts, and another entry consists of credit to some other one or more accounts. So this aspect is most relevant and most it has no any defect or limitation. No, dual aspect concept. If some order is given, then I will place this top ranking, because in every other aspect there are some, even going concern is not always true. Not always true. Not true for ever and ever. It is true, but not forever. But dual aspect concept is always true. And money measurement concept has certain limitations. It cannot measure everything in terms of money.
Non-monetary.
And what was the first business entity concept? Sometimes it gets mixed. No, sometimes it becomes difficult to differentiate which transactions are, because if a person makes a call from his mobile phone, personal mobile, even for business, then
but that would not be recorded.
No,
But it is
mobile.
not money measurement.
No, mobile bill.
Okay.
He can claim that I am using my car for business, although it is my personal. So sometimes it gets mixed. Okay. So going concern, business entity concept is also not that much clear. Then second one was money measurement concept. There are many important things which can be measured in terms of money. And then cost concept. What is the cost concept about?
The cost concept, that everything is recorded at the cost.
Oh, at cost. But it is also not true. It does not reflect current position.
Yeah, true image of the entity.
So cost concept is also limited. Going concern concept is already we discussed already. That it is not
Apt.
It is not correct forever. But this dual aspect concept, this is always correct. And all our accounting, especially book double entry system of accounting, and there is no any other system anyway. The dual aspect concept. The concept is based on double entry bookkeeping, which means that accounting system is set up in such a way that a record is made of the two aspects of each transaction that affects the records. The recognition of the two aspects to every transaction is known as dual aspect concept. Recognition of two aspects of every transaction is known as dual aspect concept. Modern financial accounting is based on dual aspect concept. One entry consists of debit to one or more accounts, and another entry consists of credit to some other one or more accounts. However, the total amount debited is always equal to the total amount credited. There can also be a question like this. All debits are equal to all credits. All debits equal to all credits. Which concept deals with this fact? Dual aspect concept. The recognition of the two aspects to every transaction is known as dual aspect concept. Modern financial accounting is based on the dual aspect concept. One entry consists of debit to one or more accounts and another entry consists of credit to some. However, the total amount debited equals to its total amount debited is always equal to the total amount credited. Therefore, at any point of time, total assets of a business are equal to its total liabilities. Liabilities to outsiders are known as liabilities, but liability to owners is referred to as capital. Thus, this concept expresses the relationship that exists among assets, liabilities, and the capital in the form of an accounting equation, which is as follows.
Asset is equal to liability.
Liability plus capital, or capital is equal to assets minus liabilities.
Wow, I was also there.
Or liabilities is equal to
Assets minus capital.
Since accounting system requires recording of the two aspects of each transaction, this concept shows the effect of each transaction on them. Assets and liabilities are two independent variables, and capital is
Owners.
dependent variable. Assets and liability are independent. You cannot make changes in them, but capital will keep changing because capital is equal to assets minus liability. If assets increases and liability remains same, independent. What is the difference between dependent and independent? Asset will not depend upon your capital, but capital will depend on assets. This is the main point. So capital is dependent, and assets and liabilities are independent variable. There may be a question on this line also. According to dual aspect concept, assets and liabilities are independent variable. Correct or false? True. Assets and liabilities are independent because capital depend upon them. Like you can just for the sake of clarity, I am giving a practical example. A child is dependent variable. Mother and father are independent because father will not change according to child, or a mother will not change according to child, but child will depend. So I think now you will not forget. I have given such a. So child is capital, and father is liability, mother is asset. So assets minus liability is equal to capital. So since accounting system requires recording of the two aspects of each transaction, this concept shows the effect of each transaction on them. Assets and liabilities are two independent variables, and capital is dependent variable. For why capital is dependent variable? Because it is the difference between assets and liabilities. That's why it is capital is dependent variable. Don't get confused that capital is independent. You may think that why owner can introduce capital anytime and asset will increase. You can also think in this way, but that is not correct. You have to think other way. When assets increases, capital also increases. Okay. So be clear. Don't get confused anymore. Capital is dependent or independent? You will get confused a few more times, but then after your mind will settle. Your mind will accept this fact, because at this point your mind is creating some resistance. No, capital is independent. How can we dependent? Capital is introduced first. Are you thinking in this way? Sometimes I read your mind that you are not accepting this line 100%. Anyway. So, why capital is dependent variable? Because it is the difference between assets and liability. Any change in any one of these three must lead to change in any of the other two. So if all are if third one is dependent upon other first two, then that means everything is dependent. Everything is dependent variable. No, but since the question is read like this, capital is equal to assets minus liabilities. Capital is equal to assets minus liabilities. Capital is taken as function or dependent variable. Now our next is concept, realization concept. But or I will not take more than 10 minutes now. Realization concept. According to this concept, revenue is recognized only when a sale is made. Revenue is recognized only when sale is made. It may be sale of goods or sale of services. There is not necessity that money is also received. Money was sale is made. So at which point of time revenue is recognized?
When sale is made.
When sale is made. So realization concept. According to this concept, revenue is recognized only when a sale is made. Unless money has been realized, that is, cash has been received, or a legal obligation to pay has been assumed by the customer, no sale can be said to have taken place. So there may be two situations: either money was realized immediately, or at least he has an obligation has been created on the customer that he will pay in future. So in both cases, if any of these two happened, then only we can say that sale has taken place. If nothing was received by you and he also not agreed that he just take it like robber, they don't make a promise that we will pay in future. So you cannot say that there was a sale, or if goods were lost due to fire, or it was theft due to theft, or gifted. In these cases there was no sale. Why there was no sale?
Because money is not received.
Neither money was realized immediately, nor any promise was received. Promise was made by customer. So, nor any legal obligation created on the person who took the goods. No sale can be said to have taken place, and no profit can be said to have arisen. It prevents business firms from inflating their profits by recording incomes that are likely to accrue. That is, expected incomes or gains are not recorded.
Only expected losses and
that is another thing. That is known as, that is convention. That is a conservative convention of conservatism. So in realization concept, until and unless revenue is recognized only when sale takes place. In realization concept, when revenue is recognized, when sale takes place, and sale takes place when either money has been realized immediately, or
there is some legal
obligation has been created on the person to whom goods or services were sold. If neither of them have happened, then there is no sale, there is no question of recognition of revenue. Why closing stocks are not recorded at market value? Suppose closing stocks were lying and their cost was 5 lakh, but they can be sold in the market for rupees 8 lakh.
But they have not been sold.
Because of realization concept. No, realization concept. They have not been realized. There is no sale. If there is no sale, then how can we realize? How can we recognize revenue? We have neither sold those stocks, so there is no question of recognition of revenue. And since there has been no sale, no question of profit. That's why closing stocks are recorded on cost, not at market value. But why fixed assets are recorded on cost and not at market value? Which concept is behind this? Going concern concept. And to record closing stock at cost, not at market value, which concept is behind this? Realization concept. Because realization concept can't be applied in case of fixed asset, because we never we never hold fixed assets to realize. That's why realization concept can be applied there. Their going concern concept will be. So this type of discussion is really very helpful, not only for the student, but for innocent teacher like me. Because there may be question, why closing stocks are stated at cost and fixed assets also stated at cost? There may be a statement. Fixed assets are stated at cost. Closing stock also stated at cost.
Which concept?
Now which concept are behind fixed asset stating at cost, being stated at cost, and stock being stated at cost?
Fixed for fixed asset going concern for cost stock realization.
Realization concept. So let's repeat this realization concept quickly and then we will read about next. Realization concept. According to this concept, revenue is recognized only when a sale is made. Revenue is recognized only when sale is made. Revenue is recognized only when sale is made. This is based upon revenue match concept or realization concept or money measurement concept.
Realization.
These are quite confusing because this revenue match concept is also here. But if somebody listen about revenue, okay, it must be revenue match concept. So revenue is recognized only when sale is made. This is based upon realization concept. Okay, so realization concept. According to this concept, revenue is recognized only when a sale is made. Unless money has been realized, that is, cash has been received or legal obligation to pay has been assumed by the customer, no sale can be said to have taken place and no profit can be said to have arisen. Okay, so money can be realized in two ways, or either cash should be received immediately or there is some legal obligation. So unless money has been realized, realized is different from received. Received is a narrower term. Received means actual receipt, but realized means it covers both receipt of money as well as legal obligation. So until money has been realized, no sale can be said to have taken place and no profit can be said to have arisen. It prevents business firms from inflating their profits by recording incomes that are likely to accrue. Like if closing stock is inflated, it will show a higher amount of net profit. Customers will become happy. Bankers will so much profit, quite good net profit is you. So here there is a point. Normally many people do this trick. Their stocks, there was an exporter in Paharigan, stocks worth rupees 50 lakh were lying with in his godown, but he used to show it at rupees 1.5 crore. Because that is the weak point where profit can be inflated. But in the next year, he will pay the consequence. He will in opening a stock. Because the same amount of closing stock will be paid as opening a stock. So in the next year also, his profit will be get reduced by 1 crore, which he had shown extra.
So
but
what is the
for the current period, he used to say, and again in the next period, again the same trick. Again, it's an inflated closing.
So in every consecutive
every year, but finally this does not pay in long run. So which concept prevents business from showing inflated amount of profit? Realization concept. So there may be many questions on a single concept. Now next is accrual concept. Every transaction and event affects one or more or all the three aspects, which assets, liabilities and capital. We are talking about accrual concept. Accrual concept is also it is somewhat similar to dual aspect concept. No. Okay. Now let's read, then we will interpret. Accrual concept. Every transaction and event affects one or more or all the three aspects, which assets, liabilities and capital. Obviously there are three persons and everybody will, either one or two or all three will be affected. Normally all transactions are settled in cash, but even if cash settlement has not taken place, it is proper to record the transaction or the event concerned into books. This concept implies that the income should be measured as a difference between revenue and expenses rather than the difference between cash received and disbursements. Income should be measured as difference between revenue and expenses, not as a difference between cash received and cash paid, right? Or cash payments and cash receipts. So income should be measured as a difference between revenue and expense. Income should be measured as difference between revenue and expense. Which concept describes this fact? Accrual concept. Accrual concept. Income should be measured as a difference between revenue and expenses rather than the difference between cash received and disbursements. Business transactions are recorded when they occur and not when the related payments are received or made. At which point the business transactions are recorded? When they occur. This is you must use this word only. Occur. When transactions occur, not when money is paid for them or received for them. Business transactions are recorded at which point of time business transactions are recorded? The time when transactions occur. You can reply it very specifically and correctly only when you know this line. Otherwise, people may say when we sell something, when you buy something, they may give many examples, but they will not speak the specific line. This is the most appropriate and most specific. Business transactions are recorded at the time when transactions occur. Now, transactions will cover everything. You need not elaborate and speak many sentences in favor of this. Business transactions are recorded when they occur. That's all. So, the concept business transactions are recorded when they occur and not when the related payments are received or made. This concept is called accrual basis of accounting, and it is fundamental to the usefulness of financial accounting information. It is not necessary that there is an immediate settlement in cash for every transaction or event. Therefore, accrued revenues and costs are recognized as they are earned and incurred and recorded in the financial statements of the period. On the basis of this concept, adjustment entries relating to outstandings and prepaid expenses and incomes received in advance, etc. are made. So all adjustments which you normally find after footnotes in the trial balance. So all adjustments are made because of this concept and how difficulty is faced in taking into account those adjustments. And this concept because up to trial balance it's okay, but when those 10 or 15 adjustments, they create problems, especially in preparing balance sheet. Up to PL account it's okay.
No, everything is okay.
But at
only
the time,
the balance sheet does not match.
Yeah, that is the point of problem. Because anybody can make PL account happily. Somebody says, I know 50%. Can you cover remaining 50%? Okay. I will make PL account. Just 5 minutes more. So it is not necessary that there is an immediate settlement in cash for any transaction or event. Therefore, accrued revenues and costs are recognized as they are earned and incurred and recorded in the financial statements of the period. On the basis of this concept, adjustment entries relating to outstanding and prepaid expenses and income received in advance, etc. are made. They have their impact on the profit and loss account and the balance sheet. Next one is point number 8, accounting period concept. It is customary that the life of the business is divided into appropriate parts or segments for analyzing the results shown by the business. Although it is fact, it is also a concept. It will go on and on, but there must be some definite period, short period for making a. Otherwise, we will not wait till the business ends, and then we will record everything. It makes no sense. Every user will die and business will go on. So accounting period concept has also been.
It is divided into small periods.
It is customary that the life of the business is divided into appropriate parts or segments for analyzing the results shown by the business. Even if, take another example, even if a person say lives for 90 years, and if somebody or friends or family member ask what are your achievements, I will tell you about the time of my death. So normally people also analyze what they have done in this year, what they plan to do next year, or in this month.
6 months.
This is, many busy persons divide their life into weeks or days. What was the achievement of today? How many lakhs or crores we earned today? But poor people measure in terms of year. What was my income for this year? But very rich people, they will count for every day. It depends upon position. So accounting period concept. It is customary that the life of the business is divided into appropriate parts or segments for analyzing the results shown by the business. Each part or segment so divided is known as an accounting period. It is an interval of time at the end of which the income or revenue statement and balance sheet are prepared in order to show the results of operations and changes in the resources which have occurred since the previous statements have been prepared. Normally the accounting period consists of 12 months. But in case of big company, it consists of 3 months. Quarterly results are published. Now, last one is revenue match concept. Revenue match concept. This concept is based on accounting period concept. So there may be a question. Accounting period concept is based on revenue match concept. Correct? No, revenue match concept is based on accounting period concept. In order to determine the profit earned or loss suffered by the business in a particular defined accounting period, it is necessary that the expenses of the period should be matched with the revenues of that period. The term matching means appropriate association of related revenues and expenses. Appropriate association of related revenues and expenses. Okay, we have to associate appropriately related revenues and expenses. We cannot appropriate some other kind of expense with other kind of revenue. Appropriate association. According to this concept, so therefore income made by business during a period can be ascertained only when the revenue earned during a period is compared with the expenditure incurred for earning that revenue, not for earning any other revenue. For earning that revenue, that particular revenue. Like if I am earning fees from my clients, I have to take into account expenditure which are incurred towards earning fees. I cannot take into account my traveling expenditure to when I go to my native village, because those expenditure are not to earn that revenue. So according to this concept, adjustments should be made for all outstanding expenses, accrued incomes, unexpired expenses, and unearned incomes, etc., while preparing the final accounts at the end of the accounting period. Let's revise quickly this last one. Revenue match concept. The concept is based on accounting period concept. In order to determine the profit earned or loss suffered by the business in a particular defined accounting period, it is necessary that expenses of the period should be matched with the revenues of that period. The term matching means appropriate association of related revenues and expenses. Appropriate association of related revenues and expenses. Therefore, income made by the business during a period can be ascertained only when the revenue earned during a period is compared with the expenditure incurred for earning that revenue. Okay. Income made by the business during a period can be ascertained only when the revenue earned during a period is compared with the expenditure incurred for earning that revenue. According to this concept, adjustments should be made for all outstanding expenses, accrued incomes, unexpired expenses and unearned incomes, etc., while preparing the final accounts at the end of the accounting period. Now see, here also, according to this concept, adjustments should be made for all outstanding expenses accrual, because basically this concept is based on accounting period concept. And in accounting period concept, going concern is divided into small period. And in accrual concept also, we had seen this line. It is not on the basis of this kind of adjustments entries relating to outstanding and prepaid expenses and income received in advance are made. So adjustments for prepaid and outstanding expenses or income are made on the basis of both concepts, accrual concept also and revenue match concept also. Okay, so all these 9 concepts we discussed, and name of these 9 concepts, just name and then let's wind up. First, business entity concept. Then second, money measurement concept. Third, cost concept. Fourth, going concern concept. Fifth, dual aspect concept. Sixth, realization concept. Seventh, accrual concept. Eighth, accounting period concept. And ninth, revenue match concept. Okay.